In this video, Jim Cramer provides an insight analysis aimed at guiding investors through a turbulent market landscape marked by negativity and caution. Jim emphasizes the significance of upcoming economic data to help clarify market uncertainties and encourages selective buying during market dips.
Ignored values. Ignored because it's very hard to buy stocks ahead of the tariffs and a Fed that's no longer willing to help by cutting interest rates, at least for the moment. Look, the bargains are out there, but no one dares to take them because the analyst hedge fund journo complex has created endless fear by emphasizing we are in a stagflation moment, even as I'm not buying it, not one bit. The glass is half full here or maybe more. And the tariffs will soon come to pass, and then they'll be behind us. You can see that stocks want to go higher. If we get just a little bit of a reason to be more positive about the looming April 2nd wave of tariffs, stocks can bounce. It doesn't even have to be much. I mean, today during the midday press appearance from the Oval Office, President Trump signaled some flexibility on tariffs, saying, quote, the word flexibility is an important word, right? He used it. Sometimes it's flexibility. So there'll be flexibility, but basically it's reciprocal. Boom. That honestly didn't provide all that much more clarity, but the market seemed to like the word flexibility. I like it, too. After all of the major averages were decidedly negative this morning, all of them finished in positive territory, proving once again that there is too much gloom. This morning, investors were obsessing over the negative earnings updates that we got from the likes of Nike and FedEx, figuring that the former was yet another argument that the consumer's rolling over, while the guidance cut from the latter showed that, well, commerce in general is slowing down. The negativity even extended companies with reports that I thought were very positive, such as chipmaker Micron. When Micron reported last night after the close, its shares initially climbed nearly 7% in after-hours trading. But overnight, investors decided that, well, in fact, they hated the quarter, and the stock was well into the red before the opening bell. Thankfully, though, we got no additional reasons to be negative during the trading session, and that word flexibility gave us a glimmer of hope. Encouragingly, we didn't even see the late Friday selling. It's become an unwelcome staple of the second Trump era. Investors have been booking profits due to the fear of weekend Truth Social posts that could roil the market. But today, stocks actually rallied into the close to preserve the modest gains of the day. So now let's look at next week's game plan with an eye toward what's bad. So we're ready. Take KB Homes, which reports on Monday after the close. The home builder has inflation issues and has mortgage issues, right? Rates are too high. The stock's down from just under 90 to around 60. So you could say those are now baked into the stock price. But some investors thought the same way about Lennar, another national home builder that reported an upside surprise on earnings, but talked about how housing prices are going down, albeit slowly. But that was certainly enough to kill that stock. So I don't see a bottom in KB Home, especially when it's trading at 42 in the fall of 2023. The stock's had a relentless run. Time to bide your time. Wait for a better moment. For the record, if you insist on owning a home builder, do you mind if you just go with Toll Brothers? I think that's best of breed. Lennar did shake off more than half its losses by day's end, closing at 115. That's only down 5. I saw it at one point down 12. Lurking behind all the negativity here is the likelihood, yes, of a recession. Recession aided by stagflation. Now, if you think that's in the cards, if you think there's going to be a recession, you should really consider buying McCormick, which reports Tuesday. This spice company's been putting up big numbers, but even better, you buy their seasonings when the economy rolls over, because during a recession, people do less dining out, more cooking at home. Very positive for McCormick, which dominates the spice and seasoning aisles. After the close here from GameStop. Now, this stock has been a propensity to go up, both before and during the earnings report, and then it just starts to lag because nothing ever really happens. Maybe they'll announce some plan to lever up and buy some Bitcoin. In the end, you can't game GameStop. Wall Street used to love the dollar stores because, unlike most retailers, they kept putting up stores and generating good growth. They went into neighborhoods other retailers steered clear of, carrying what looked like inexpensive merchandise. Well, that changed during the pandemic. They raised their prices and raised them in order to pass on the value proposition, and it's never been the same, right? There is no value proposition. These days, the reduced sizes often give you the appearance of value, but people know when they're getting had. That's why I'd stay away from Dollar Tree. This thing does not represent the kind of value that we want or that I used to get when we used to go there all the time. By the way, even Walmart's struggling. So when Dollar Tree reports Wednesday, I'm not thinking it's going to be great. We got a pair of small business-oriented companies that also report Wednesday. Cintas and Paychex. Cintas rents uniforms, provides many other services to small, medium-sized businesses. Last time I reported, the market didn't like it, and the stock got drilled. I'm worried about small business formation right now, and therefore I have to worry about a company like Cintas that sells uniforms and then takes care of them. As for Paychex, this payroll processor is a lot of bearish analysts covering it, and I got to tell you something. They got smoked in that last quarter, just smoked by the great numbers. Paychex, I think it's going to continue to do well. Be sure to pay attention to Chewy when it reports on Wednesday morning. This online pet food store has been going strong now for the last 2 quarters, ever since they called the bottom of Mad Money. They're crushing it. Thursday, we're going to hear from Lululemon, and oh man, this is a battleground. I mean, just incredible. Lots of short sellers betting that Lulu won't sell enough because of its high price point. I think this is a remarkable company. That makes me want to buy the stock on any weakness. We also have an Investor Day event for Dutch Bros. I like the Bros. I like the Bros CEO, Christine Barone. But man, oh man, this is one expensive stock. Regional and national growth story for the coffee chain is still very much in place, which means Dutch Bros can be bought on weakness. We get pending home sales on Thursday, and we're trying to assess whether there really is a huge slowdown in housing. Instead of just some anecdotal negatives by one company or another, numbers can help spell it out. Desperate for something good that the Fed cares about? We also get the personal consumption expenditure numbers on Thursday, and this is their favorite inflation indicator. Unfortunately, it hasn't been a good one. Sentiment seems to be turning south. I don't know how I feel. I don't know about you, because of these geopolitical worries. But we lack hard and fast data that confirms this new worldview, and that's why I'm grateful for the University of Michigan Consumer Sentiment Index on Friday. If it's real negative, it will confirm the action we've seen in the last couple of weeks. So here's the bottom line. There's a lot going on next week, but until we get some resolution on the trade front, you need to expect more uncertainty, more volatility like we saw today. There's just too much negativity, and for the moment, it seems impossible to fight it. Although when it gets extreme for no reason, as it did this morning, you still have to pounce, if only for a trade.